get credit for the RCH credit. So, and I'm going to turn off my video so that if there's activity behind me, it's not distracting. All right, can everyone see my screen okay? Great, 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 great. That's all I wanted to know. So before we get started, I did want to just kind of, I don't know, it's not really apologize, but I know that this particular topic is a little dry and it's kind of boring and hard to get into a little bit. But it is crucial to know these things for the CPP or FCP exam. Not only that, it's actually really important as you're processing payroll for your clients or customers. So, or your employers, just make sure that you're grasping these topics, the glossary items, all of the pre-tax and post-tax things. So I will try to make it as easy as possible to just breeze through this information. Today we're going to start on taxable tips. Because of the special nature of tip income, with employees' wages being provided to a great extent by customers rather than the employer, there are always special rules that apply. Keep in mind that every state may have different rules. So you're going to want to make sure that you know those specific state rules. However, the CPP exam is just referring to those federal laws when it comes to minimum wage and how tip income is then calculated. Employees must report their tip income to employers if they receive at least $20 in a month in tips. That gets reported on Form 4070. Withholding on tip income, tips are subject to federal income tax, FICA, and FUTA. Tips are deemed as paid when they are received from the customer. Under reported tips, the employer is only liable for the portion of FICA. Your allocated tips means that those tips are required and from food and beverage establishments with 10 or more employees per day if the 8% threshold is not met. Do not withhold income tax, Social Security tax, or Medicare tax on those allocated tips. Allocated tips are reported only in box 8 on the W-2. Your tip rate determination, the IRS tip rate program, aims to improve and ensure compliance by employers and employees with statutory provisions relating to that tip income. So, employer loans. Employers have the ability to loan monies out to their employees. A de minimis below market loan is when the outstanding principal of all below market loans made to an employee does not exceed $10,000 on any day during a year. No portion of the discounted interest is subject to federal income tax, FICA, or FUTA taxes. A below market loan exceeding $10,000. If the loan balance exceeds $10,000 on any day, the difference between the interest charged by the employer and the IRS rate of interest is subject to FICA and FUTA taxes and is reported as federal wages, though federal income tax is not required. Employee relocation loans. There are special provisions when a loan is made in relation to the employer's relocation of an employee. No additional income results if the loan is secured by a mortgage on the new principal residence, or if it's a bridge loan not secured by a mortgage and payable in full within 15 days. Forgiven loans is any loan forgiven by the employer that is considered compensation to the employee and is subject to federal income tax, federal employment taxes at the time the loan is forgiven. A loan to exercise non-statutory stock option is where an employer loans money to an employee at the applicable federal interest rate to purchase employer stock, then reduces the principal of the loan when the stock's value declines. The amount of the reduction in principal is income and is therefore subject to federal income tax, FICA, and PUDA. Keep in mind that these particular items were on last year's test. Who knows if they'll be on this year's, but definitely good items to know. Here's your first pop quiz. An employee was given a below market loan of $17,000. The current IRS interest rate is 9%. The employer charges 7%. Calculate the income to be added to the employee's Form W-2. If you answered A, 340, that would be correct. When an employee has loans provided by the employer in excess of $10,000, the employer must impute interest into the employee's income if the interest rate the employee pays is less than the applicable federal interest rate. Sick leave pay. Most employers provide their employees with paid sick leave or sick days, so they will receive their regular salaries for brief absences from work due to illness or injury. Payments are made from the regular payroll account and are taxable wages. We're going to go through these fairly quickly just because there's a few different options of sick leave pay for third parties. You'll just want to make sure that you understand how those items are calculated and where those differences are. Reimbursements under an accountable plan for sick leave pay. If the payments are made by the employer, that is where employer's sick pay plan is self-insured. The employer bears the insurance risk and the employer then makes those payments. When payments are made by the employer's agent, this is where employer contracts with a third party to administer its disability plan and pays the third party on a cost plus fee basis while retaining the insurance. Payments made to disabled employees by the third party are treated as if they're made by the employer. If payments are made by a third party who is not an agent, this is where the employer contracts with a third party insurer to make the disability payments to employees, and that third party bears the risk of insuring the employees. It assumes a greater role in the area of tax responsibility. Pop quiz. If a third-party sick pay is reported on Form W-2 under the name and EIN of the employer, who's responsible for filing Form 8922, the third-party sick pay recap? Very good. The insurer. The insurer is responsible for filing Form 8922, third-party sick pay recap, when third-party sick pay is reported on Form W-2 under the name and EIN of the employer. Form 8922 provides the IRS the ability to reconcile the differences between Forms W-2 and 941 when the employer and the third-party sick pay providers share the responsibility for reporting and depositing.
Hey, Rebecca.
Yeah.
This is Darby over at Darby Woodlands. Do you have an example of the payments made by a third party who is not an agent?
I do not. I do not. Typically,
Would that be like Aflac or?
Well, Aflac would then be the agent, potentially, depending on how if Aflac is insuring the employee, then they would be the agent. So it's the most common option is when the employer's interaction with it is only the fact that they're paying the premium. Does that make sense? You're rarely going to have the other options.
Okay.
Stock options and purchases. A stock option is an offer by a company to sell shares of its stock to employees at a specified price. Incentive stock options are statutory, so are employee stock purchase plans, and the non-qualified stock option is non-statutory. A vesting schedule identifies how quickly an employee will be eligible to purchase their company stock. Income tax withholding is not required when an individual exercises a statutory stock option because no income is recognized at the time of the exercise. We have just a few little glossary items here for different stock options. You have the grant, which is a stock option grant occurs when the employer gives the employee the right to acquire stock in the future at a fixed price. The employer may place various restrictions on that grant, and generally there's no tax consequence to the employee at the time the option is granted. Exercise. The exercise of a stock option takes place when the employee acquires the company's stock at the fixed price at which the option was granted. Depending on the type of stock option exercise, there may or may not be tax consequences to the employee at the time of the exercise. The spread is the difference between the two prices for the stock that is subject of the option. The spread at exercise is the difference between the price the employee pays to acquire the stock and that fair market value of the stock on that day. The sale occurs on the date the employee sells the stock they acquired through the exercise of the option. The grant may place conditions on the sale of the tax consequences of the sale to the employee will depend on the type of option, the period of time the employee has owned the stock, the price at which the stock was purchased and sold. All of those things will be taken into consideration. We can go through one example of stock options. Anne is granted an option under a plan that satisfies the requirements of an employee stock purchase plan. The option allows Anne to acquire 50 shares of her employer's stock at an exercise price equal to 85% of the fair market value of the stock at the time the option is granted. Fair market value of the stock at the time the option is granted is $100 per share, and exercises the option later when the fair market value of the stock is $120 per share. At the time of exercise, Anne acquires 50 shares of stock having a fair market value of $120 per share for $85 per share. Anne pays cash to acquire the shares of stock. 4 months later, Anne sells the stock for $160 a share, and then so on. So you can see at the bottom of this example exactly how much of it would actually turn out to be taxable income or not taxable income to the employee and how it's reported on Form W-2. Under stock awards, if an employer pays employees with company stock instead of cash as compensation for services rendered, the fair market value of stock when transferred to the employee without restrictions would then be considered wages subject to federal income tax withholding, Social Security, Medicare, and FUTA taxes. That's most typical for your highly compensated employees. In our example, again, I'm going to let you guys read those at a later date while you're studying. Here's your next pop quiz. What election do employees make when they choose to have the fair market value of stock included in income before the stock has been vested? We can maybe go back to one of our examples, I think, shows an employee making that choice. It does not, and man, and I'm sorry I did not catch that in the slides. Employees can make an 83B election, which allows the employee the ability to elect to include income of the fair market value of the stock at the time of election. So there, gave you a little freebie for that one. We all are familiar with workers' compensation. That's a form of insurance employers are generally required to buy to insulate them against lawsuits brought by employees who are hurt or become ill while working. Payments received as workers' compensation benefits are not included in employees' gross income and are not subject to any employment taxes. Dependent care assistance. One of the things you need to make sure that you're watching, especially with regard to taking the CPP or FCP exam, is are they looking for any type of annual, meaning is it a 2021 rate? Are they looking for the amount of limitations that for the exclusion of income for reimbursements of dependent care assistance? Are there going to be any changes? So if you look at this particular slide, there is a 2021 difference for the American Rescue Plan Act that provides temporary increase of the income exclusion for dependent care assistance programs. For 2021, the maximum excluded amount of dependent care assistance cannot exceed $10,500, $5,250 for married individuals filing separately. We don't know exactly what's all regarding COVID or ARPA, the CARES Act. We don't know all those things that are going to be included on the exam. We haven't seen any sample questions yet, but keep in mind, because these are federal mandates, likely you're going to see some. And we have another slide coming up. Severance pay under other payments. Severance pay is pay provided to employees because they were terminated. This must be included in the terminated employee's income. It's subject to federal income tax withholding, Social Security, Medicare, and FUTA. These amounts are subject to taxation as supplemental wages when they are paid to employees. A golden parachute is when companies change ownership. Quite often, key executives are provided with a golden parachute to soften their landing should they be terminated by the new owner. It's typically a large settlement that those key employees receive. Club memberships. In essence, employers can exclude club due payments or reimbursement from an employee's income to the extent they are business related and the employee substantiates the business portion of them. The exclusion applies even if the employee's use of the club is primarily personal, so long as the business use can still be substantiated. That would be something like country clubs, golf clubs, airline clubs, hotel clubs, and the like. Adoption assistance. Adoption assistance is not included in an employee's income if it is eligible. The maximum exclusion is $14,400. The assistance is adjusted for income over $2,016,660 with no exclusion to employees making over $254,520 a year. The term eligible child, to have the adoption be deemed for an eligible child, is an individual who is under the age of 18 or is physically or mentally incapable of caring for him or herself when the adoption assistance is provided. Those qualified adoption expenses include reasonable and necessary adoption fees, court costs, attorney fees, travel expenses, and other expenses related to the legal adoption of an eligible child. The differential military payment is compensation paid to employees while on military duty that represents the difference between employees' regular pay and the pay provided by the state or federal government. That is referred to differential military pay. Keep in mind that would be things like if you have employees who are called, that are in the military reserve and they're called to active duty, and you're paying them a portion, even if they're in the National Guard and they go away for their 2 weeks or things like that in the summertime. So keep in mind that you do need to know how to properly pay your military staff. Another pop quiz. All of the following benefits are taxable except what? Great. If you answered on-premises athletic facilities, you are correct. Under the IRS rules, the employee's use of on-premises athletic facilities is excluded from income. Payment of meal expenses during a move, employee group term life insurance in excess of $50,000, and incentive awards are taxable income. Those are all those topics we covered yesterday. This is the slide I was referring to a moment ago for COVID-19 related taxable and non-taxable compensation. This is something that you're going to want to review. You should know these things to be processing and handling your employee payroll now anyways, but with regard to the CPP and FCP exam, it's really hard to say which of these items are on there. Keep in mind that your exam is only going to cover those federal mandates. So for employers here in Colorado, we have the Colorado rules in place as well for like the public health emergency. Don't let that confuse you. Those will not overlap into the exam because the exam is only the federal mandates. So now we're going to start with deferred compensation. Your deferred compensation plans can be classified into 2 different groups. You have qualified and non-qualified plans. Your qualified is a 401k or 403b, and your non-qualified plans is 457b. Under the 401k or 403b, your current income deferred and accumulated until retirement with qualified plans must meet many requirements found in IRS regulations. There are way less regulations that govern over those non-qualified plans. Your qualified plans, a pension plan provides a benefit that is determinable when the employee retires and is payable over a period of years, usually the employee's life, and the employer's contributions to the plan are not based on profits. A defined benefit plan provides a certain level of benefits during an employee's retirement, a level generally based on the employee's age, compensation level, and length of service. Defined contribution plan, on the other hand, contains individual accounts for each employee with a set amount being contributed into the account by the employer and sometimes the employee periodically. So you definitely want to make sure you know the difference between a defined benefit plan and a defined contribution plan. They're 2 very different things. A profit sharing plan is a defined contribution plan to which a company agrees to make substantial and recurring contributions, although they may be discretionary to some degree. Amounts contributed to the plan are invested for eventual distribution to participants or their beneficiaries either at retirement after a fixed number of years or after a specified event occurs: death, disability, separation from employment, etc. An after-tax contribution is any benefit may be purchased by employees through deduction from their wages and after-tax dollars. And if you look at the way this calculation or this mathematical setup is broken down, The after-tax deduction is directly above the net pay. So all of those tax items are calculated first, and then that after-tax deduction. A pre-tax contribution, on the other hand, when plans meet the regulatory requirements, employees may elect in advance to have their wages reduced by a specific amount to pay for the benefit. Under deferred compensation, the pre-tax deductions only reduce the amount of wages subject to federal income tax. So then it makes that mathematical equation just a little bit more complex in the event that you first need to decide what wages are subject to federal income tax. So instead of having that deduction right above net pay, it's deducted first to determine how much of those wages are now subject to federal income tax, although the full gross wages would still be subject to FICA, to Social Security and Medicare. Pop quiz. An employee earns $4,500 per month and defers 3% to a 401k plan. The employee is paid semi-monthly. Calculate any federal taxes that must be withheld from the employee's monthly 401k deferral. And our little test tip is you're sometimes given some unnecessary details that will not come into play for your answer at all. However, it's meant to kind of make sure that you pay attention to those words. So how much tax is calculated on that deferral? Nice job. Looks like everybody got it. We're close. The correct answer is 1033. Under IRS rules, employee contributions to a 401k plan are not subject to income tax, but are subject to Social Security and Medicare taxes. This is another super helpful slide that I suggest you pay real close attention to. You are going to need to know those maximum deferral limits for every type of benefit plan or compensation plan. It's super important to know that they do change every year. You need to know the limit on income, the limit on contribution, whether or not there's a change for the catch-up limit, all of those things. And then this table also tells you if federal income tax wages are calculated. See how it is calculated on the Roth, but on none of the other plans. That is going to be the huge difference between a Roth and a regular 401k or 403. The tax treatment of pension and profit sharing. When certain requirements are met under the Internal Revenue Code 401A regarding employer contributions, they are excluded from wages and not subject to federal income tax, FICA, and FUTA. Those requirements are based on participation, vesting, the contribution limits, benefit limits, and it cannot discriminate in favor of highly compensated employees. Employee after-tax contributions to a qualified plan are generally included in income and are subject to federal income tax, FICA, and FUTA taxes. Also keep in mind payments from plans are taxable when received by the employee or retiree. The portion of after-tax contributions are not taxable. Additional 10% excise tax is charged to the employee who is pulling monies out, but they have not yet attained age 59 and a half. Although retirement benefits paid from a qualified plan generally are included in income, they are not subject to FICA and FUTA. The best way to think about that is under a 401k as an example. If the employee is paying it pre-tax, The only thing they have not yet contributed to is federal income tax. They've already paid that FICA tax on it. So there would be no point in them having to pay it again when they start utilizing the monies that are in that fund. Qualified annuity plans under a 403. An annuity plan meeting many of the same requirements of a 401A, pension and profit sharing plan regarding vesting, participation, contribution, and benefit limits and non-discrimination is a qualified annuity plan under a 403A. Employer contributions to a qualified annuity plan are not included in wages and are not subject to taxes. You have several ERISA requirements. ERISA is a federal law that sets the minimum standards for qualified pension plans in private industry. ERISA does not require any employer to establish a qualified pension plan, but does establish certain minimum standards. The Department of Labor Employee Benefits Security Administration, or EBSA, enforces that ERISA. Those are items, just terminology you're going to want to know. Deferred compensation regulations. Under qualified plans, you have profit sharing plans, defined contribution plans, defined benefit plans, 401k. Essentially, those qualified plans must be in writing and communicated to employees. Benefit of employees or their beneficiaries be non-transferable and non-forfeitable. They must satisfy rules related to eligibility and minimum vesting, and they cannot be discriminatory. Non-qualified plans, unlike the qualified, non-qualified plans, can be discriminatory. So typically, any place that has those highly compensated employees, they may also have those non-qualified plans. Pop quiz. Sorry, we have a lot of them today. An employee earns $970 semi-monthly and defers 13% to a 401k plan. Calculate any federal taxes that must be withheld from the 401k deferral. The correct answer is $9.65. If you take $970 times the 13% is $126.10. Take Medicare and Social Security out of that, it is $9.65. More deferred comp regulations. There are a ton, just FYI. Cash or deferred arrangement, or CODA, allows employees to have their employer contribute as part of their salary to a plan rather than receiving the salary in cash. The employee's portion is a pre-tax contribution. It is subject to taxes when withdrawn, generally referred to as a 401k plan. The plan is usually made available to employees through a salary reduction agreement under which the employee agrees to a reduction in salary, or a thrift type plan, you may see that term as well, or a deferral of future raises or bonuses, which is a bonus type plan. And of course, as we saw on that table before, there are contribution limits. Every single year, those limits change. Your catch-up contributions. Those are for employees who are 50 or older. That limit for 2021 is $6,500 per year, so they get that on top of the $19,500. Catch-up contributions are considered a separate payment and apart from other contributions. They must be available to any eligible employee to participate on all eligible elective deferrals. Those catch-up contributions are considered on an aggregate basis. Another important item to remember with those catch-up contributions is the employee turning 50 years old who is eligible to have a catch-up contribution. If they don't turn 50 until December 31st, 2021, it doesn't matter. All of 2021, they are eligible for that catch-up contribution because they turned 50 within the year. Holding periods for elective deferrals. Generally, employers are required to transfer elective contributions to a qualified defined contribution plan as soon as they can be reasonably segregated from the company's assets. For plans with fewer than 100 participants, the employer has a safe harbor of 7 business days to get the contributions into employees' accounts. What this is saying is an employer has 7 business days after pay date, when those monies have been deducted from employees' pay, to get that transferred to their 401k accounts or 403. A default election that applies in the absence of an affirmative election by an eligible employee is called an automatic 401k enrollment. Qualified automatic contribution arrangement is an arrangement that satisfies the requirements of ADP and ACP discrimination tests for quota. Each non-highly compensated employee is permitted to make elective contributions sufficient to receive the maximum matching contribution available. Qualified percentages and the uniformity requirement means that it provides a specified schedule of automatic contributions for each eligible employee, beginning with the minimum qualified percentage of 3% of compensation. Your default versus affirmative election. The default election deferral percentage ceases to apply to any eligible employee when they make an affirmative election to either opt out or select a different amount. So if you have a default election of 3% and an employee comes to you and says, no, I want 7, that 3% is null and void, and you go with the 7 because that is now their affirmative election. Continuing our automatic enrollment, eligible automatic contribution arrangement, or EACA, provides limited relief from distribution restrictions for an eligible automatic contribution arrangement, a non-safe harbor arrangement. Your withdrawal election is an election to withdraw contributions that were made under an EACA must be made within 90 days of the first elective contribution. Distributions means the regulations provide that the distribution is generally the account balance attributable to the default elective contribution, adjusted for gains and losses, of course. You forfeit employer matches. The withdrawn amount is included then in the employee's gross income, except if it were a Roth. So this is saying under those default, if an employee says, wait a minute, I did not want to be included in this plan, and they now make a distribution, this is how you would then handle that. Tax treatment of 401k plans. Employee elective deferrals and employer matching contributions to a qualified 401k plan up to the applicable contribution limit is not wages subject to federal income tax withholding. Federal income taxation is deferred until funds are actually received or distributed from the plan. Employee elective deferrals are subject to Social Security, Medicare, and FUTA. Employer matching contributions are not subject to Social Security, Medicare, and FUTA. Employers also should check states where they operate in for any different treatment under those state or local laws regarding the income tax withholding or unemployment and disability insurance. Under reporting requirements on Form W-2, elective deferrals and employer matches are not considered wages and are not added to box 1 of a W-2. Elective deferrals must be included in box 3 as Social Security wages and 5 as Medicare, and again, boxes 4 and 6 respectively. Elective deferrals, including catch-up contributions, must also be included in box 12 with code D, and box 13 must be labeled with retirement plan checked. Your Form 941, employers do not include the elective deferrals or employer matching contributions online as wages. Elective deferrals are included though on line 5A, column 1, and 5C, column 1, as taxable Social Security and Medicare wages. On Form 940, the deferrals must be included in Part 2, line 3. Your Roth contributions to a 401k plan. The main difference between a Roth, or I should say not just the main difference, the only difference is how it's taxed. The difference is regular pre-tax 401k plan, employees are deferring their tax, saying, I don't want to pay my federal tax now. I'll pay federal tax when I retire and I'm actually receiving the money. Where a Roth, the employee is paying the tax up front right out of their checks. Then when they get the money, it's pretty much free. They don't pay any tax on it. So it's a little bit of a gamble as far as where do we think those personal tax rates are going to be by the time you withdraw those monies. So if you have employees questioning what are the main differences, that's the main thing. Whether or not you pay the federal income tax up front, or if you pay it when you actually pull the money out when you retire. Which of the following statements is true about a 401k plan? Great, yes. The true statement is contributions to a Roth 401k plan are subject to federal income tax when deferred. Deferred means when it comes out of your paycheck. I'm going to kind of skip forward because we're getting close on time and there's a calculation I really want you guys to review. I do really stress that these are important items to know. Here's a pop quiz for you, and I want to give you guys some time to work through it. So you have the following information. This particular employee is paid bi-weekly. They have an annual salary of $120,000. They're exempt. However, they've worked 45 hours in week 1 and 50 in week 2. On their 2020 W-4, you can see the selections that they've made. You can see their year-to-date wages thus far during this calculation is $87,500. And they've so far paid $19,000 into their 401k. They typically withhold 20% of their wages into their 401k, and this employee is 46 years old. I'm going to give you just a quick second to look at it, and then we're going to fill out the tax worksheet kind of together. So let's take a look at how you would break this down. Your first step is we need to figure out on line 1A, what's the employee's taxable wages? So we know that the employee makes 120,000 a year divided by 26 pay periods because they said they were bi-weekly. That is 4,615.38. The employee also contributes 20% to their 401k. What is 20% of that gross pay? Well, that's $923.07. But we know that this employee already maxed out at 19,000, so they've only got $500 left. So if we reduce their gross pay by $500, you know that what we need to put in 1A is 4,115.38. Then we're going to enter the number of pay periods. That's 26. We multiply that out and we receive 106,999.88. This employee, did they enter anything from step 4 on their W-4? No, they didn't. So we're going to put 0. We're going to add the lines C and D, and of course, because it's 0, we have the same number. Enter the amount from step 4B of the employee's W-4, that's 0. If box in step 2 of form W-4 is checked, enter 0. If the box is not checked, enter 12,900 if the taxpayer is married filing jointly, or 8,600 otherwise. Well, this employee did not mark that they were married filing jointly. They marked head of household. So that amount we're going to put in is 8,600. We're going to subtract, and we come up with 98,399.88. So now let's go down to the step 2. We're going to enter the adjusted annual wage, which is that 98,399.88. We're going to find the row in the appropriate annual percentage column. So that's going to be the column with 96,550 to 175,100. So we put in the lowest amount from column A, 96,550. Enter the amount from column C, that's the 13,293. Now we're going to multiply that by the percentage in D, which is 24%. Subtract line 2B from line 2A. So we're going to subtract those, and we come up with 1,849.88. And now we're going to multiply that by 24% to receive $443.98. Add the lines together and then divide by the number of pay periods. This gives you your tentative withholding amount of $528.35. Since we knew that this employee was head of household, they selected 6,000 as their dependent amount. We're going to divide 6,000 by those 26 pay periods that we put on line 1B, which is 230.77. And we're going to subtract the 230.77 from our tentative withholding amount of 528.35, which leaves us with a withholding amount of 297.58. So then if you look at the right-hand side of this screen, you have a per pay salary of $4,615.38. We're going to reduce it by 500 for that 401k deferral. We're going to subtract our federal income tax withholding of $297.58. We're going to reduce by the FICA and Medicare tax on the full $4,615.38. And we end up with a net pay of $3,464.72. And I can guarantee you this breakdown will be on your exam. It's not going to be just a matter of breaking down those net pays on an easy basis. They're going to throw in a few complex situations where you have to reduce it to get the federal income tax on with the 401k deferral. They will also ask you for a Roth deferral just to trick you, even though those are after tax. So keep that all in mind, that you will need to practice these calculations to know exactly how it works out. So I kind of cheated and gave you the answer, but I felt like it was important, since we've kind of skimmed through this rather quickly, to do the breakdown together. Your non-discrimination testing is when a plan is reviewed at the end of each plan year to review if it is discriminatory in favor of highly compensated employees. If it's considered to be discriminatory, there are methods that you will have to take in order to make this a non-discriminatory plan, whether that is reduce highly compensated employee balances, or then add to the rest of your employee base to increase their balances. I won't read through these examples. Here's some non-discrimination testing again. If a highly compensated employee defers income to more than one 401k plan, then elective deferrals are totaled for purposes of applying the special ADP non-discrimination test to each plan. All the employer's plans are treated as one when you're determining an employee's ADP. It's really important to remember that you have to prove that all of your plans combined are non-discriminatory, so that you can't have, you know, your highly compensated people are spread amongst several different plans and giving them that better opportunity for matching and things like that. You can always spread it into a 457, but that's neither here nor there. Pop quiz. When performing discrimination testing for a 401k plan, which of the following employees is a highly compensated employee? Great, looks like everybody got B. An employee with compensation of $135,000 in the prior year would be considered a highly compensated employee. It's always looking back to see the prior year what employees made. Getting into the non-qualified plans. Any employer plan designed to provide employees with compensation that will be deferred to a later date, usually after retirement, and does not meet the requirements of Internal Revenue Code 401A is a non-qualified deferred compensation plan. Employers often use such plans to compensate certain high-level executives. Deferrals to a non-qualified plan can include employee pre-tax salary reduction, employer contributions for matching, employee or earnings credited to the employee's account. Non-qualified deferred compensation plans can be either funded or unfunded. Those are terms you're going to want to know. There are distribution restrictions to avoid inclusion in income. A plan must not allow distributions from a non-qualified deferred compensation plan any earlier than separation from service, date of disability, death, a specified time contained in the plan when the deferral election was made, a change in control in a corporation, or the occurrence of an unforeseen emergency. Non-qualified plans, again, the deferral election requirements. A plan must provide the elections to defer income earned in a year must be made before the end of the preceding taxable year. If an employee's performance-based compensation will be based on work performed over a 12-month period or more, the deferral election must be made no later than 6 months before the end of the service period. The time and form of distributions must be specified at the time of deferral, either by the plan itself or by an election of the employee. When contributions are not subject to the distribution restrictions or deferral election requirements, the contributions are included in the employee's income. So to determine the amount to be included in the employee's income, the IRS has provided the following guidance. You can read those items. We're getting really close on time. We do have a few other slides on non-qualified plans because non-qualified is such a deep topic, but I'm going to make sure that we have a few seconds here to go over any questions you guys might have.
I don't know that I have any questions, just trying to absorb all the little facets.
Oh.
Of each.
I know, and it's so much information just jammed down your throats. I get it. And I sound like I'm talking a million miles an hour. We still have 50 more slides to get through tomorrow. So it's just, they are deep topics, but it's more important that you know, honestly, it's definitely more important that you know how to use these in everyday life. It is very important for the exam itself, but the regulatory items are super important to know in just your everyday payroll life. But practice those calculations because that will be on the exam. And I know when I did mine, there were several that had 401k. There were several that had Roth. Sometimes they try to trip you up and ask a question that's asking you what is the federal, they call it just federal income tax, and you need to calculate everything. Or they'll just say, what's the federal tax? And you think federal income tax, well, there isn't any on a 401k, but what they're meaning is they want to know the FICA and Medicare, because that is still a federal tax. So words matter. If there is not income, they're still referring to. Mandan, I'm not sure if you're seeing that question in chat.
Yes, there are several different. I will send out a couple because depending on whether or not you're going to annualize the wages or find the federal income tax by pay period, there are a couple different worksheets in that publication 15T. But yeah, I can send those out.
Yeah, definitely helpful to know each different method. Keep in mind when you do the exam, they will provide you with those tables so that you know how to do it all, but to know which rates you're going to need to look for. But it's helpful to practice. So we're just about to the top of the hour. So we're almost done for the week, guys. You're almost done hearing my voice.
Thank you for this, Rebecca.
No problem. Okay, then I guess we are all set for today, guys. Have a good day, and I'll see you tomorrow.